Ladies and gentlemen, it's us again with our third interview with Egon von Greyerz. We had some issues. Times are strange, but finally we got it done. Egon, welcome. I hope it will be a good one. As always, we have interesting topics to cover.
Thank you, Jan. Well, of course, it's always interesting because the world is interesting and markets are interesting. So let's have some fun.
Last week, the FED came out with a big announcement, and usually under normal circumstances, the gold price would have rocketed by $100 or more. They have announced not to increase the interest rate this year anymore, and also to stop the balance sheet tightening, but not much happened. Did you expect such a decision by the Fed?
Yes, I would say I did, because I mean they're always wrong in their decisions. They're always behind the curve. They have been for a long time, and there'll be an article coming out soon on that. But basically, the Fed has no idea what's happening in the market, and they only react to events. And if you look back at the federal funds rate for just take the last 20, 30 years, you will see that they react and panic after an event, which is either an economic event like the 2007-8 crisis, or after a stock market crash like in 87 or 2000, and then they lower rates when it's happened rather than anticipating it. And at the same time, they were having zero rate policy for much too long. They should have increased rates long ago, and they start doing it last year, and then they say they're going to do it this year when the economy is turning down. So of course, every clever market observer knew that the market was turning down, saw that. So therefore, the Fed had to also, later than they should. I mean, they're like a dinosaur. If somebody bites the tail, it takes them a year before it goes to the head. And that's the Fed also. They're so slow in reacting. So, I mean, my view about central banks. They shouldn't exist. They have no function whatsoever. They destroy the natural cycles which would be a lot smaller. The tops would be a lot lower and the bottoms a lot higher if the Fed didn't intervene. And therefore, sadly, the Fed shouldn't exist, nor should any other central banks. But that's not going to happen.
Egon, I'd like to visualize the current interest rates for our audience and show them a chart. Here we see the Fed funds rate from the 1950s. If you'd like to give a brief comment on it.
Yes, well, it confirms my what I'm saying. So let's talk in more modern times. We see a bottom there after the 87 crash, and then if you show on the arrow. And you do it a bit left, the bottom before that, down there. That's after the 87 crash. They lower the rates exactly where you had it, not there. No.
Here's 80, here's 85.
Yeah, so 87 is just after. That was the lowering of the rates after the 87 crash. And then they increased the rates because the crash stopped quite quickly. And then of course the problems weren't over. We had problems in the economy, problems in property markets. And then Greenspan panicked again and lowered rates from 10% in the just late 80s to 2.5% in the early 90s. And that was bad economic conditions. And then thereafter, things improved a bit. They raised them, and then you see 2000. Exactly the same happened. They raised the rate into 2000, and they are about 6%. Just over 6%, the rates in 2000, and then comes the 2000 stock market crash, and bang, they reduced rates again. And we saw the same in the 2007-9 crisis. They raised rates rapidly from about 2004 to over 5%, and then came the economic problems, and they had to lower rates again. So this is what I'm saying. They're just reacting to events. They're not anticipating anything. And now, after having zero interest rates for 7 years, now they start increasing rates. They should have increased them a long time ago. The economy has been overheating. The stock market has been going too high just because of low rates, and asset prices have been going up. And therefore, they did it at absolutely the wrong time. And that's why, as we said, I'm not surprised that they reversed now. And actually, I think we will see interest rate reductions coming now, probably this year and next year.
Yes, I agree. And as we see on this graphic, the shaded area, on this chart is probably only the end of the chart, but for us who look a bit further in the future, it indicates the next coming recession. And as we saw from the graphics, there is not much powder left what the Fed can do to support the market if there is any emergency.
No, you're right, because last time in 2007-8, rates were almost up at 6%, and so they had a lot of margins to lower Fed funds rate to zero. This time it's only at 2.5, 2.4 now, so there's no margin at all. Will they go to negative rates? Possibly, but my view is that they will lower rates now, and they'll be lowered dramatically. But that's short term, because I think then at some point financial markets will be under pressure again. There'll be lots of money printing, and then inflation will pick up, and holders of bonds around the world will start dumping their bonds. Especially, of course, China will do. They have over $1 trillion worth of treasuries. Japan has over $1 trillion worth of US treasuries, and they're going to start dumping these, and then that means that rates are going to go up, especially the longer end of the market. So after we've seen this dip in rates that might last a year or so, then we will have inflation, and we will have a bit of panic in bond markets, in my view, in the next couple of years at the latest, and then rates will go up, and the Fed will lose control of interest rates, because the long end of the market, the longer rates will pull up the shorter rates, and rates will be higher all around the world, which is what really the long-term interest cycle is telling us. So I think we are, after a short period of lower rates in the next year or so, we will see rates going back to where they were in the 1970s and early 80s, which is in the teens or higher, 15, 16%, or even higher, up to 20.
But the current financial system probably will not survive that. I have another.
No, they want to. That's absolutely a good point, because most countries cannot survive with take Japan. They can't survive with a 1.5% interest rate, and nor can Europe, and the US. Okay, so it's slightly higher there, but no one can survive with the rates that we saw in the 70s, 10, 15%, which means that there will be just unlimited money printing to cover those interest expenses, and a vicious cycle of higher inflation, higher interest rates, more money printing.
I have another very interesting graphics for our audience. I will get this quickly. We see here two graphics from the pretty well-known US website Shadowstats. In the past, we learned that if the real interest rate, that means the nominal interest rates subtracted by the inflation, becomes negative, it's a perfect time for gold, because officially, or the bankers always told, gold carries no interest, so it's not, you should not own it, better go into bonds that give you an annual yield, or in dividend-paying stocks. But if the real interest rate is negative, then this advantage, at least for bonds, vanishes, and gold becomes attractive. But over the past decades, we had several adjustments in the CPI calculation in the USA. We have here two different old CPI calculations that Williams from Shadowstats used, and that means that the real inflation, according to old means of calculating them from the past time, is much higher than officially announced, and that again means that the real interest rate is much more in the negative area than officially stated. And I think if the public would be aware of that fact, the gold price would be much higher. What's your thought?
Yes, no, you're absolutely correct. So the method of calculating inflation was changed in I think it was 87. And so what John Williams of Shadow Statistics is showing here is what the rate would be if it was calculated the same way as before. I mean, you know, authorities, they love cheating and they love manipulating figures to show false figures rather than the truth, because it's always in the interest in government to show low inflation. But anyone who goes shopping and buys food will know that we have massive inflation, and that's what John Williams shows in these figures. So you're right. The real inflation is a lot higher, and therefore what you were saying, which is correct, is that therefore inflation is a lot higher than interest rates, which is beneficial for gold. But it hasn't happened yet because the market also believes that the rates, the inflation is lower than it is. It will happen. You know, this is the thing. Gold doesn't react to events. Gold doesn't react to long-term to a Fed decision or to something happening in the marketplace. Gold reacts over a longer period normally as a result of debasing the currencies or of printing money, and therefore making the currency worth less. And that's what the gold reflects over time. So, you know, I have no shadow of a doubt that gold will, at some point in the very near future, start reflecting what's happened in the economy. They're trying to hold it at these levels, you know, this Maginot line that I've been talking about at around 1350, 1360 is now a line where they're trying to defend. They will fail in defending that line. The gold will go through that, just like sadly the Germans broke through that line in the Second World War. So to get into France, so it will happen, and once it happens, whether that's be in the next few months or so, then gold will go up a lot faster, and they're not going to be able to hold it back.
Egon, only to show our followers, I was a bit too fast to show it, but here it is. That shows you the difference between 10-year US treasuries subtracted by 3 months treasuries, and usually if you have a normal since structure curve, then the long maturities always yield higher, or always have higher interest rates than the short ones. So this graphics should always be in the positive area, but now it just turned to 0. That means that the short-term interest rates equal the long terms, and the real interest rate, even with those phony measurements of the Fed, becomes negative. So it's a perfect sign for us for gold and for the next recession, because this also, when the interest structure curve becomes inverted, that means that the short terms have higher yields than the long ones, is a clear sign for a coming recession. And that always speaks for lowering interest rates and again, money printing like there's no tomorrow.
No, that's exactly right, because this is what the argument I made just a few minutes ago, that the Fed controls the shorter rates, and they're behind the curve, but the longer rates, like the 10-year, is much more difficult to manipulate by the Fed. So that is a market rate, and the market is telling us that rates are coming down, and therefore you have this what we call an inverted yield curve, when the longer rates are lower than the short rate. So that's a clear indication of a recession coming, of lower rates coming, and of problems coming in the world economy again.
We have a very current topic that just came into the news this morning, the Brexit. The British Parliament rejected all 8 possibilities they have, or Mrs. May presented them to vote for, so they have rejected everything. I think that is one of the possible black swans that we talked about in our last interviews that could bring it down, or maybe might be used as a scapegoat to justify what's going to come next. What do you think?
Well, you mentioned Brexit, and of course I have connections with the UK because I lived there for a long time, and I still have a house in the UK. Brexit is on the news in the UK every day from morning to evening. And then I just spent a few days in the US, and last week, watching US television. And that was all about what they call the Mueller report, Mueller or Müller in German. This was the investigation into Trump's links with Russia, etc. The Democrats were trying to catch him in any way they could in order to impeach him. And that was on the news all the time. So this shows you the quality of the news and the quality of the debate. So in the UK, which is a major economy, it's only Brexit, and in the US, it's only about Trump and can we get rid of him. So no one is running the country. They're all focusing on minor problems. Brexit is, of course, a bigger problem, and I don't know if it will be a trigger. It'd be bad for the UK, this period of indecision, because I'm a great believer that the UK should leave the EU. I'm not in favor of the EU as it is today. I'm not in favor of an elite in Brussels, which is unelected and unaccountable, decides over 500 million people. I think the EU should be what it was from the beginning, like EFTA, i.e. Free Trade Organization. So I know this will be controversial with some of the German viewers, but nevertheless, I think EU is not going to survive. The euro is not going to survive, and Brexit in whatever form it takes, and of course the Brussels elite are trying to do everything they can to stop Brexit in any manner, and whether they succeed or not, it's not going to change the longer term. In the long term, the EU will not stay together as it is. And nor will the euro survive. So there will be major political changes in Europe in coming years, and that will have an effect on the economy and on the European economy, on the world as a whole. Because you add to that all the banking problems. You have the banking problems in Italy, in Greece, Spain. You can go further to France, and then you can even include your Deutsche Bank, which has a balance sheet which is awful, and derivatives position which is much too big for not just Deutsche Bank but for the country. So there will be banking problems in Europe, and they will happen they might start within a year or so, and that will spread around the world. So this is all part of what we talked about before. The money printing will start again to save all these banks, to save all the problems and the deficits. And then inflation will start shooting up again, and potentially leading to hyperinflation.
Egon, I think you have more people here that share your opinion about the European Union and their future outlooks as you think. So there's a very rapidly growing critics movement also in Germany that say that the European Union as it is now will not survive, and it's hold together with the euro, and we are on the final stages, and the Brexit, who knows, it can be used as a scapegoat, or the Deutsche Bank and the Commerzbank, they bring together two lame ducks to make a sprint star, but we know
to make a dead duck. Two lame ducks make a dead duck. That's what's going to happen.
They only want to do, I think they want to bring the Deutsche Bank under the state umbrella to save them easier. But at the end, we have to, as mentioned, or as I said the last times, we have to use the remaining time wisely and take precautions. And if there's anybody who likes James Bond movies, I recently found a very interesting scene. I will not play it here, but I will link it in the video, where Goldfinger talks to James Bond and telling him that he doesn't want to remove the 10,000 tons from Fort Knox. It's absolutely sufficient to make it unusable. And the similarity to our modern times, there are 10,000 or how much tons in New York and Fort Knox, and both did not see any physical audit for decades. So if you want to hide something, or if you want to make it unusable, then you simply have to prevent the access to it. And this is my concern, that something similar might be in the cards, because this fraud, we have every argument on the positive side for gold, and the price movement is still slow. I think there's something big coming. Final words, Egon?
Yeah. Well, it's a possibility, but the thing is, the gold is probably not there in the first place, as you say. So therefore, sure, if they make it toxic by a nuclear material or bomb, sure that could suit their purpose. But you know, at some point, the market will require an audit of that gold, especially if they're going to use the gold to back a new currency or a drawing rights, etc. And if they then say that it's going to be gold back, you know, China and Russia are going to say, okay, show us your gold, because who's going to accept something backed by gold that doesn't exist? And that's so whatever happens, I mean, the US at some point will have a major problem with the fact that the gold definitely isn't there. And if it was there, they would anyway have to write down the dollar and revalue the gold, you know, dramatically to actually be able to cope with their debt. And then you're talking about gold going up, you know, at least 10 times, if not more. So they're interesting. So you either have the fact that they have to revalue the gold if they have it, which I don't think they do, certainly not the 8,000 tons they say they have, or alternatively, the market will find out that there is no gold, and of course then gold will shoot up also. So those two alternatives are both in favor of gold, and one of them will happen in the next few years. That's absolutely certain.
Well said for now. Thank you, Egon. We had some issues. I excuse our audience. We had some frozen screen in the video, but the sound was at least okay. Exciting times. Till next time. Goodbye.
Thank you, Jan. Good to talk to you.
Bye.